Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
Good morning, Dean. I'm doing well. How about yourself?
Great, thank you. Today we're going to talk about understanding financial and economic concepts. We hear a lot about some of the terms out there, whether you invest on your own or you work with a financial planner or advisor. So what we're going to do is talk about some of the financial and economic concepts that are out there, some of the basics that I think you need to know a little bit more about. And some of these are going to be positive. They could be negative towards your investment and your retirement plan. And the first one we're going to talk about is interest rates. We hear a lot about interest rates, and when we had a bit of a market downturn in February of 2018, people started referring to interest rates as possible cause for the downturn. And I think people were really just grasping when they were identifying interest rates, because we've been in a low interest rate environment for some time. However, we're starting to creep up. And with interest rates on the rise, that is a good sign for some people and a bad sign for others. Some people who are looking to put money away and save, it's a good sign because interest rates are increasing. For those looking to borrow, it's not a good sign because you're going to be paying more interest on your debt. So let's talk about the basics first, Tyler, interest rates, and then we'll talk about a little bit more in depth, such as simple interest versus compound interest.
Yeah, Dean, and with interest rates, I think the first thing that we should cover is the definition of what an interest rate is. So really, an interest rate is the rate at which a borrower is charged or the rate at which your principal grows. So really, it works two ways. It can be charged on someone when you're buying something, so you're either paying interest or you're receiving interest when you're saving something, like your savings account, money market account, CD, different things like that. Obviously, everyone would like to be saving and earning that interest instead of paying that interest out, but really, in reality, we probably all do pay interest at one point, whether it be through a mortgage, student loans, a car, credit card, whatever it may be. Interest is always going to be there. Now, interest rates, they're a basic financial concept that help drive the economy that not too many people know about, and they don't really understand how it works with the overall economy. But really, on a more personal level, individuals like me and you, we borrow money to purchase homes, fund projects, start businesses, pay for college, buy cars. So there's really a number of different things that we that interest rates, how they affect us on a personal level. But then big corporations as well, they borrow money to fund projects and expand operations. They buy land, different types of vehicles, machinery. So interest rates, everyone at some point is going to have to be, or they're going to be charged interest on different purchases. Now, on the other side of that, interest rates are also used for savings vehicles like your savings account, money market accounts, CDs, and fixed annuities. So different types of investments where you put money in and you save over time. You can also make interest on that. Now, like Dean said, right now, obviously, interest rates with them being so low, there's not too many people that are earning a whole lot in a savings account, a CD, a money market account, with interest being where it's at right now. And again, that does help people who are buying right now, who buy a mortgage, buy a car, different things like that, because they're not paying as much in interest. Now, the main concept here that we want to touch on in terms of saving is simple interest versus compound interest. And surprisingly, not everyone knows or is aware in terms of how these two interest rates work. So we're going to start with simple interest first. And really, simple interest is the interest rate calculated on the original amount. So your original principal, what you put into an investment. So for example, if you were to invest $10,000 in a CD or a fixed annuity that earns, let's say, 2% simple interest per year, then you'll simply earn $200 each year. So let's say it's a 5-year CD, then you'll be earning $200 each year. So that's 2% on your original amount, $10,000, that's $200 in year 1, year 2, year 3, year 4, and year 5. So again, simple interest rate calculated on each year on the original amount. Now on the flip side is compound interest. And compound interest is an interest rate calculated on your principal, the original amount that you put in, plus any accumulated interest. So oftentimes this is also referred to as earning interest on your interest. So we'll use the same example. If you invest $10,000 in a CD or fixed annuity and you earn 2%, but that 2% is compound interest, then the first year you'll earn $200. So that's 10,000 times 2% is $200. But in year 2, you'll actually earn $204 instead of $200, and that would be $10,200 times 2%. So really, you're earning interest not only on what you put in, so your own principal, but then also the interest on top of that. And each year that'll increase simply because you're earning more on the interest each and every year.
Okay, good points, Tyler. I just want to throw something in here, and that is when it comes to interest, I think it's fair to say that typically simple interest is on more conservative positions, investments in retirement plans, cash positions, CDs, fixed annuities, and so on. When you're talking, and Tyler explained and gave you an example of compounding interest, very important because compound interest typically generates wealth. So as we're talking to people as they're looking at investments and retirement plans, we want to make sure that you have compounding interest. There's double compounding, there's triple compounding interest, but really generating wealth is typically through compounding interest versus simple interest. Simple interest typically, not always, but typically tied to more safe or guaranteed money positions.
Yep, and one other thing, you can actually go on investor.gov, and there's a compound interest calculator where you can see, okay, if I want to invest a couple $100 per year, and then you put in a hypothetical interest rate, and then the amount of years that you plan to invest that, it'll show you the effects of compound interest, how over time that investment will grow due to the compounding interest. The one last thing that I wanted to touch on with interest rates is kind of looking at where we are now as opposed to the past. And really historically, interest rates, they move based on the economy and inflation. And the current interest rates are slowly creeping up from all-time lows after the 2008 recession. So after the recession, interest rates were then at all-time lows, and they're still very low, but they're slowly creeping up. Right now, the current federal funds rate is between 1.4 and 1.5%. Now, whereas back in the early 1980s, interest rates were actually over 20%. And we don't see anything like that today, obviously. So right now, you might be looking at a 30-year fixed rate mortgage and might have to pay a 4% interest rate. And again, that's just a ballpark figure. Could be a little lower, could be a little higher, but possibly right around 4%. Now, if you go back to the 1980s, even early 1990s, that same 30-year fixed rate mortgage might have been 14 to 15% per year on that mortgage. So again, interest rates, they really affect buyers as well as savers. And right now where we're at, buyers are definitely the ones that are going to be benefiting from that. And they are going up slightly. So over time, it'll shift. But right now, with interest rates being so low, you'll probably get better bang for your buck if you're buying something getting a low rate as opposed to trying to save within a savings or money market account where you're going to make almost nothing.
Yes, and also use when it comes to interest rates, if you have a financial advisor, I know we talk to our clients about this, there are certain investments that are interest rate sensitive. I mean, interest rates do affect bond positions and bond prices and yield, so you need to look at that. There are also certain investments that are interest rate sensitive, like real estate investment trusts and so on. So have that conversation with your advisor. If you have a statement that you have some questions on, want to know if interest rates are affecting it negatively or positively, feel free to give us a call, stop in the office. We'd be more than happy to look at your statement and give you some feedback. Our office number is 920-347-9888, and we're located on Allied Street in Green Bay, Secure Retirement Solutions. Okay, a couple other things before we go on, and that is Tyler brought up interest rates in the 80s and 90s. Sometimes you sit down with a client, you reminisce a little bit about the old days, and they'll talk about 5% interest rate on savings and a 10% interest rate on CDs, which is wonderful. But I also bring to their attention, don't forget you paid 17 to 18% interest on your mortgage too. So they go hand in hand. Okay, the next thing we want to talk about is inflation. We haven't really talked about it a lot over the last 3 or 4 years because the economy has steadily grown very positive and favorable. However, in February of 2018, we went into correction territory. The stock market did, and we'll be talking about corrections here soon too, is people started talking about inflation for the first time in a while. And when people start talking about inflation, unfortunately, it usually negatively affects the market, which it did do. So, we're going to talk about inflation. Inflation isn't always a bad thing, okay? Typically, yes, but not always. So we're going to talk about the basics of what inflation really is and how you can look at it. Tyler, let's talk about the basics of inflation.
Yeah, Dean, and first off, inflation, it's the increase in the prices of goods and services over time. So inflation, it's another major economic indicator and something people need to account for when saving. So making sure they have investments that can keep up with the rate of inflation, that they're not too conservative. And then also spending, so making sure that they account for increased expenses each year due to inflation. Those are a couple things that many people forget to take into consideration. Now, according to the People History, the average cost of a new home in 1930 was $3,845, so about $3,800 for a brand new home in the United States, which sounds like a pretty darn good deal.
It does.
Now, obviously, that was back in 1930. If we fast forward to 2013, so in 2013, the average cost of a new home in the U.S. was $289,500. Another one, we have the cost of a gallon of gas. Back in 1930, that was 10 cents. So you pay a dime for every gallon of gas. Now in 2013, the average cost of a gallon of gas was $3.80. That's decreased since then. But still, those are two examples that just show us how inflation works over time and how each and every year, decade, and whatnot that passes, the prices of those goods and services are going to go up over time. And inflation is really not a hard concept to understand, but many people don't account for it within their own financial plan. And just to kind of detail how inflation works, when an economy demands goods and services faster than those goods and services can be produced, that tends to bid up the prices for those goods and services. So people are going to pay more and more for those, which that leads to increasing inflation rates. So really, ultimately, it's based on supply and demand when you look at inflation.
Okay, and when you talk about supply and demand, so you do see the trend here, as Tyler was explaining, that inflation typically happens when the economy is moving in a favorable position or direction. And it is. The economy is growing right now. People are feeling very good about it. So that's where inflation typically ekes its way in there. Consumer confidence is at a high, so people are buying more products than they did a couple of years ago. Therefore, many times the manufacturers cannot keep up with that supply or with that demand, So what they do is increase the price on these items. So inflation typically goes hand in hand with an economy that's moving in a positive direction.
Yeah, and interest rates, like you said, Dean, they can be used to combat inflation, which can lead to different economic conditions. So really an interest rate increase, it attempts to minimize future inflation, and higher interest rates will slow down spending. So really, if interest rates are, if they rise on your a mortgage or a car, student loans, different things like that, people are going to be less enticed to go and spend that money if they're going to have to pay a higher rate. Whereas an interest rate decrease attempts to spur economic growth, which could eventually lead to inflation. So lower interest rates, on the other hand, that encourages spending. So, you're going to have to pay a lower rate. You're probably going to be more willing to spend that money and buy something that you don't have to pay as high of a rate on. And now that's kind of more the general macroeconomic level, but inflation also ties in on more of a personal level. And it's very important consideration when we put together a financial plan for both pre-retirees and retirees. And what I mean by that is oftentimes we see where someone who's retired, they hold almost exclusively very conservative or fixed investments, such as money market accounts, CDs, and fixed annuities. And at that point, if you hold only investments like that, you could run the risk of not outpacing inflation and you can actually lose purchasing power over time. So what I mean by that is you might have all in different types of fixed investments right now that aren't making much in interest that may average 2% per year. Whereas if the inflation rate is 3% per year, sure, on your account statements, you see that money growing, but really you're losing purchasing power because your expenses are going up more than what your investments are growing by. So really people run the risk, again, if they hold too conservative investments and they don't have anything set aside for the growth portion that can outpace inflation, then they could lose purchasing power over time. And that's why we think it's important to stay diversified within your portfolio and have, we take the 3-bucket approach. I know we've touched on it in this show before, but we like to have your safety investments, your income producing, and then your growth investments. So really your safety and income investments can be something that will be a bit more conservative, and then some of your income and then your growth investments are what you can use to try and outpace inflation. So you really want to be diversified and have a balanced approach that way.
Okay. We're going to continue with inflation, but before we do, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, the continued conversation on inflation. As Tyler brought up, when you look at inflation, as we get older, people tend to get safer with their retirement income, their plans and their investments. That's important. It addresses the first bucket of the 3-bucket approach when it comes to preparing and staging your retirement, the safety, and then we look at income and growth. But again, unfortunately, we see a lot of people that become too safe. It's hard to say. But I mean, it really, there is an opportunity to become too safe. What people do is typically lock down too much in cash positions, CDs, and other fixed investments or retirement plans. You need to address and make sure you also have income and growth. And typically with growth, you're going to be taking more risk. Okay, income is somewhere in the middle there. But we put together financial plans for clients, and we always account for inflation. You have to look at inflation. It is going to be with you for the rest of your life. At what particular time, we don't know, but it will be in the future. So when you put together a financial plan, you want to stage inflation to show that your expenses will go up. And at times interest rate increases, you have to look at in your financial plan. Now, we put together complimentary financial plans for our clients or anybody else who would like to have one, and we scrutinize both interest rates and inflation. So if you'd like to have a financial plan put together, give us a call, stop in. We'd be more than happy to do that, and we will address inflation and interest rates. Tyler, anything yet on inflation before we go on to the next item?
One last point I wanted to cover there, Dean, with inflation. We made it pretty clear that you want to make sure that your investments can keep up with inflation, but then also you want to take inflation into consideration when you budget your expenses. And this is what so many people don't do. But let's say, first year you're retired, you spend $5,000 a month. Well, a decade later, you might be spending $5,500 or $6,000 a month on the same exact items you're buying now, and that really shows inflation over time. So ultimately with inflation, just make sure that your investments can outpace inflation and that you account for inflation within your expenses, so you can also make sure that you can pay those expenses throughout your retirement.
Okay, good point. The next item we want to talk about when it comes to some basic investment terminology or economic terminology is bull market and bear market. We heard a lot about that most recently, especially when we went through the correction just recently here in February of 2018. But people really don't know what makes up a bull market and a bear market. It's good to know that. We're also going to talk about certain percentages that you have to come off or grow on highs or lows to determine whether there's a correction, bear market, and so on. We're also going to take into consideration people gain significantly during certain markets. For instance, the bear market. If you're younger, hanging in there for a longer period of time is probably good for you. We're also going to see in certain situations where the bull market really hasn't helped certain people. So Tyler, before we go into talking about specifically the bull and bear market, are there any certain percentages we look at to determine whether it's a bull or bear market?
Yeah, Dean, usually with a bull or bear market, 20% is the number that we keep in mind. Now, with a bull market, that would be a 20% increase off of a recent low point, whereas a bear market, that would be a 20% drop off of an all-time high. So if we go back and look about a month from now, actually a little over a month, in late January, the stock market, the S&P 500, hit an all-time high. Now, within a week or two after that, it dropped 12%. It had a 12% drop in early February. Now, a 10% decline or more is a market correction. If that 12% would have turned into a 20% drop, it didn't, but if it would have, then it would have been termed a bear market. So 20% is the number that we look at to determine a bull or bear market. And again, a bull market refers to a stock market on the rise. So that usually means the economy is in a good state, and unemployment is also relatively low. And keep in mind, we've been in a bull market now for over 9 straight years, even though there has been some recent volatility where the market's gotten a little bit shaky. But we have been in a bull market, and a bull market encourages buying, and many investors are optimistic during a bull market. That's what we've seen over the last decade or so from 2009 onward, where the market is going upward. People are buying into it. They're feeling a bit more optimistic. Whereas a bear market, that's the exact opposite, where the market is declining, which it could signal potential economic trouble. Not always, but sometimes it can. And a bear market isn't always bad, especially for people who are younger and contributing to a retirement account at work. You just got to keep on plugging away. And at that time, when the market does go down, just know that you're actually buying into shares at a lower value when they drop, and you have a higher risk tolerance and a longer time horizon, so you can afford to contribute when the market's going down like that. However, on the other hand, pre-retirees and retirees, they're typically much more concerned during a bear market, especially when they're taking withdrawals from the account, because during a bear market, your account is dropping in value and you're taking withdrawals, you're taking more money out too. So it's kind of a double whammy there, so to speak. You don't have time on your side, and you're probably more conservative than when you were younger. So really, that's why we advocate actively risk manage investment portfolios for retirees and pre-retirees. And Dean, if you just want to give our listeners some insight on how an actively risk managed portfolio could help them during a bear market.
Sure, Tyler. First of all, a risk managed portfolio takes advantage of both markets, bull and bear market. And the attempt here is to help, keep from bear market losses. Now, you cannot 100% keep from losses if you're in the market. You are taking that risk. Understand, if you are in the stock market, you are taking risk. But what we try to do here is mitigate that risk. If you look at portfolios in 10-year increments over time, it's typically not those portfolios that have significant growth that end up extremely favorable after the 10-year time period. It's those portfolios that mitigate downturn. So you don't have to take such significant risk to pick up a good portfolio gain. You really want to protect against the downside. So a risk-managed portfolio takes advantage of having money in the stock market yet, whether it be stocks, bonds, mutual funds, exchange-traded funds. And basically what happens here is, let's use as an example an IRA for $100,000. If the stock market starts showing some volatility like we were starting to see at the end of January, early February, you take a $100,000 portfolio and you might sell $10,000 to $12,000 to $15,000 worth of equity positions when the market is high. So you build up that cash. You have $15,000 of cash there. So as the market starts to go down, you have built up cash. You've taken gains when the market is good, when the market's a bull market. When the market goes down, and it does stabilize lower than when you built up that cash, you're able then to take that cash, go in and buy equity positions, and basically come out of that trough. That is the approach for a risk-managed portfolio. Understand, it's to help keep from bear market losses. You cannot 100% keep from losses if you're in the market, but if you can mitigate those and get a return quicker than the rest of the market, that's what you need to do. Also understand too, Tyler was talking about bull and bear markets. the bull market, we actually saw some people that were hurt by this significant bull market. In 2017, if you look at the trend line of the market, it was, the lower left-hand corner, it started and it ended in the upper right-hand corner, okay? I mean, it grew significantly in 2017. There were some people that did not participate because they were sure that the market was not going to grow at that pace. They thought we were at all-time highs. We couldn't get any higher. So they missed out on some significant double-digit returns. We tell people instead of all in and all out, we like you to stay in the market, okay? However, it doesn't mean all of your portfolio needs to stay in the market. You can build up cash when times are volatile, so you can use that cash to help mitigate against bear market losses.
Good points there, Dean. So really with an actively risk-managed portfolio, it's not just a buy and hold strategy. We're making moves if and when the market dictates. It's not just going to sit there and go with the ups and downs of the market. And we'll make moves for one of two reasons: to either try and pick up more gain or try and minimize loss. So really, actively risk-managed portfolio, there's going to be moves that are made. It's not a buy and hold strategy.
Okay, as we're starting to come to a close here in the last few minutes, we're going to talk about liquidity. This is a term that we hear a lot about. You'll hear advisors say, well, you need more liquidity in your portfolio. Really what that means is you need to have access to money, whether it be cash or something that can be turned to cash quickly with no surrender fees or no fees of any sort, I guess. And the reason you want that is if you get into a situation with expensive health concerns, or you need a new roof, or there's an emergency, you want to have some liquidity. You don't want to go into investments or into retirement plans that have surrender fees that could hurt you if you try to take that money. Tyler, anything else on liquidity?
Yeah, Dean, just the main thing with liquidity is that you always want to have a portion of your investments or savings that is accessible. So that's what liquidity is. It's a term used to define how accessible your money is. And really what we recommend, whether you're in retirement or younger yet, to have at least 3 to 6 months of living expenses in a savings account, which is fully liquid for different types of emergency expenses. And on top of that, just make sure that your portfolio is diversified within your investments, that you have some money that's in different liquid positions where you can liquidate and get that cash quickly if you should need it. But then again, some investments like CDs, fixed annuities, different things like that can be a necessary part of your portfolio, but they can oftentimes be illiquid. So you want to have a portion of your funds then that can be accessed easier without penalties or fees. So really, just remember to stay diversified and always have an emergency fund set aside so you can have liquid funds if you should need it.
Good points, Tyler. That's all the time we have this week. See you later, folks, and hope you'll join us again next week.
See you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.